Good evening. I'm your host, and tonight we are analyzing a celestial event on the trading floor that has every major desk from London to Singapore on high alert. In the language of technical analysis, we call it a shooting star. To the casual observer, it's just a candle with a long upper wick. To the professional economist, it is a warning shot, a sign that the bulls have charged toward the sun, only to have their wings clipped by a sudden, violent realization of value. As we close out the final sessions of 2025, the S&P 500 and major crypto indices are flashing this exact signal. The question tonight isn't just did the price fall, but has the great 2025 bubble finally burst? Tonight we decode the anatomy of a reversal. The anatomy of rejection, a shooting star appears when an asset opens, rallies significantly to new highs, but then collapses to close near its opening price. In economic terms, this represents a failure of conviction. We saw this play out today as the markets attempted to breach the psychological 7,000 level on the S&P 500. For a few hours, optimism was peak. By the closing bell, that optimism had been replaced by a long shadow of doubt. When buyers push the price up but cannot hold the territory, it suggests that the smart money is using the spike to exit, leaving retail investors holding the bag at the top. The 2025 deleveraging crisis, this isn't happening in a vacuum. We are currently navigating a treacherous year-end environment where the 1 trillion wiped from the crypto market since October is casting a long shadow over equities. The shooting star is the visual representation of a liquidity drain. With the extreme fear index currently sitting at 23,100, the market is no longer buying the dip, it is fleeing the peak. The AI boom, which acted as the engine for most of this year's gains, is finally facing the gravity of high interest rates and tariff panic, residuals, the resistance wall. The shooting star is most lethal when it forms at a multi-year resistance level. Today's rejection at the 6,950, $7 zone indicates a major supply overhang. Volume confirmation: today's star was accompanied by a 15% spike in selling volume, suggesting this isn't just a tech breather, but a coordinated institutional rotation. The crypto contagion, Bitcoin's failure to hold the 100,000 mark and its subsequent retreat toward 84,000 has broken the momentum shield that protected high-growth stocks all summer. Bitcoin printed a shooting star candle at $90,200 before collapsing to 87,60 by day's end. Think that's just crypto being crypto? Here's what should grab our attention. This exact technical pattern appeared only twice before in Bitcoin's history. Once in April 2021, right before the crash from 69,000, and again in November 2021 at the absolute peak before the 73% collapse that wiped out trillions. But Bitcoin's shooting star is just the opening act. The real story is what's happening in the S&P 500. And it's a warning signal that has appeared only once in 154 years of market history. The S&P 500's CAPE ratio, that's the psycholically adjusted price-to-earnings ratio. The most reliable valuation metric we have, just hit 39.4. Let me put that in perspective. In the entire history of American stock markets dating back to 1871, the KP ratio has exceeded this level exactly one time, December 1999, the peak of the dot-com bubble when it reached 44. 2. We all remember what happened next. The S&P 500 collapsed 37% over the following 2 years, and it took 25 years for investors to fully recover their losses. Pop quiz. What do you think happened to people who bought stocks when CAPE hit 39? They lost money. Not sometimes. Every single time in recorded history. Right now, our stock market is valued at 37 trillion in total market capitalization. The forward price-to-earnings ratio sits at 22 times, meaning we're paying 22 for every dollar of expected future earnings. These aren't just numbers on a screen. These are the savings accounts, retirement funds, and college tuition. Payments of everyday Americans being valued at levels that have preceded every major crash in modern history. Here's where it gets interesting. Federal Reserve Chairman Jerome Powell stood before Congress in September 2025 and explicitly warned that stock valuations are on the high side. The chairman of our central bank, the man who controls interest rates and money supply, publicly stated that our markets are overvalued. Yet 6 months later, institutional money continues flooding into passive ETFs, creating the illusion of stability and upward momentum that feels unstoppable. You've seen this movie before, even if you don't realize it. In 1999, Fed Chairman Alan Greenspan warned about irrational exuberance in December 1996 when CAPE was only 28. The market ignored him and rallied another 80% over 3 years before imploding. During that rally, retail investors felt like geniuses. Every dip was bought. Every skeptic was mocked. Every warning was dismissed as outdated thinking from people who didn't understand the new economy. Sound familiar? The mechanism behind today's danger is actually quite simple when you break it down. Passive investing through index funds and ETFs has fundamentally changed how money flows into our markets. When you buy an S&P 500 ETF, you're not evaluating whether Microsoft or Apple or Nvidia are fairly priced. You're just buying everything in the index proportionally. This creates a self-reinforcing loop. Money flows into ETFs, which mechanically buy stocks regardless of valuation, which pushes prices higher, which attracts more money into ETFs. It works beautifully on the way up. But here's what most investors don't understand. The same mechanical process works in reverse. When money starts flowing out of ETFs, the funds must mechanically sell stocks regardless of valuation. No human judgment. No, this company is cheap now. Just forced selling that accelerates as prices drop, triggering more redemptions, forcing more selling. We're now at the point where passive ETF ownership represents 47% of all U.S. equity market capitalization. That's the $14 trillion in mechanical buying pressure that can instantly become mechanical selling pressure the moment sentiment shifts. And unlike 1999, when individual investors made their own buying and selling decisions, today's market moves are amplified by algorithmic trading, systems that execute in milliseconds, based on technical signals. Which brings us back to that shooting star candle. In technical analysis, a shooting star forms when an asset opens, rallies strongly during the session, then closes near its opening price after rejecting higher levels. It's called a shooting star because it looks like one on the chart. A small body at the bottom with a long wick pointing up, showing that buyers try to push higher, but sellers overwhelmed them in the cold, analytical landscape of late 2025 finance. The shooting star appearing at the S&P 500's 7,000 threshold marks a definitive inflection point where marginal demand is finally eclipsed by institutional supply. For months, the market has been propelled by the dip psychology, but as we graze this monumental psychological ceiling, the air has become dangerously thin. This is the hook, that professional desks are watching the transition from a momentum-driven rally to a distributive phase. In economic terms, marginal demand refers to the final wave of buyers, often retail participants driven by the fear of missing out, who enter the market at peak valuations. When these buyers exhaust their capital, there is no one left to push the price higher. This is precisely when institutional, smart money executes its exit strategy, utilizing the high liquidity of retail FOMO to offload massive blocks of shares without immediately crashing the price. The intraday price action of a shooting star is a masterclass in behavioral manipulation. It begins with a deceptive surge that breaks previous highs, luring in the last remaining sidelined capital. However, as the index approaches the round number, resistance of 7,000, it hits a literal wall of pre-programmed sell orders. The long upper wick is the visual signature of this rejection. It represents billions of dollars in aspiration that was met with the cold reality of profit-taking. For the sophisticated observer, this isn't just a technical fluke. It's a signal that the cost of equity has finally caught up with the reality of high interest rates and the slowing AI infrastructure cycle. We are seeing a classic distribution top, where the hands holding the asset shift from strong, long-term institutional players to weak, late-cycle speculative hands. This buyer exhaustion creates a structural vacuum. Once the final buyer has entered, the only remaining path for the market is a search for lower liquidity. This is why the shooting star is so lethal. It proves that at 7,000, there is zero conviction left in the bull case. The market reached for the sun and found only a massive supply overhang. As we head into the 2026 fiscal rebalancing, the question is no longer whether we can break 7,000, but how many of these late entry retail positions will be liquidated as the market reverts to its mean. We are not just looking at a candle on a screen, we are looking at the exact moment the 2025 everything bubble ran out of fuel. The music hasn't just stopped, the chairs have already been moved. In the mechanics of a late 2025 market, the shooting star is the visual signature of a structural liquidity vacuum that is fundamentally altering the DNA of price action. For the last 3 years, the Federal Reserve's quantitative tightening program has been a relentless silent partner, draining nearly $4 trillion from the financial system and bringing the balance sheet down to a leaner $6.5 trillion. However, as we approach the final trading sessions of December, the hook that every institutional desk is grappling with is the sudden end of this runoff. While the Fed officially halted Treasury redemptions on December 1st, 2025, the market is finding that stopping the drain is not the same as filling the pool. We are currently operating in a ghost town environment where bank reserves have slipped toward the 3 trillion mark, a level that historical data suggests is the red line for money market stability. The economic engagement here lies in the year-end deleveraging phenomenon. Traditionally, December is a month of seasonal thinning as fund managers lock in their annual performance and institutional desks go light on staffing. In 2025, this seasonal lull has met a structural desert. With liquidity, shock absorbers at multi-year lows, the bid-ask spreads have widened significantly, creating a scenario where even a moderate sell order can trigger a violent downward move. Today's shooting star was the byproduct of this fragility. It took very little buying power to spike the S&P 500 towards 7,000, but it took even less selling pressure to collapse it back to the lows. We are seeing phantom price action where the screen says one thing, but the order book depth says another. Furthermore, this liquidity vacuum is being exacerbated by a massive migration into custodial wrappers like the spot Bitcoin and XRP ETFs, which have effectively locked away billions in active trading capital. This has left the marginal liquidity, the cash available to fight a correction, dangerously thin. When you combine the Fed's balance sheet runoff with a holiday, depleted market, you create a gamma trap for market makers who are forced to hedge aggressively using zero DTE options, which now account for over 60% of daily volume. The shooting star isn't just a warning of a bubble, it is the sound of the market's engine stalling because there is no oil in the system. As we pivot into January 2026, the question for the professional economist is whether the Fed's recent 40 billion Treasury purchase will be enough to bridge this vacuum, or if the star was merely the first spark of a systemic deleveraging fire. In the clinical evaluation of the 2025 market cycle, today's shooting star serves as a definitive mathematical correction to the everything bubble, a period defined by the simultaneous inflation of equities, real estate, and digital assets. We are currently navigating a valuation landscape where the Shiller-KP ratio, a measure of real price to earnings ratios over a 10-year horizon, has surged to nearly 40. To put this in perspective, this level of valuation extremity has only been reached twice in the last century, once during the 1929 crash and again during the peak of the 2000 dot-com mania. The hook for the macro strategist is the inevitable reality of mean reversion. In a healthy economy, asset prices grow in tandem with corporate productivity and GDP. However, the 2025 rally has been fueled largely by multiple expansion. Investors paying more for the same dollar of profit, rather than actual organic growth. This shooting star represents the moment the market's story narrative finally collides with the gravity of the neutral rate. For much of the year, investors operated under the delusion that artificial intelligence and green tech would provide a perpetual escape velocity from traditional valuation models. Today's price rejection at the S&P 500 7,000 mark is the first sign that this speculative fever has broken. When an asset class is priced for perfection, any data point that is less than perfect triggers a violent liquidation. We are moving from a regime of greed-driven momentum to value-driven scrutiny. The everything in the bubble is now under pressure as liquidity tightens. The correlation between disparate asset classes like tech stocks and crypto becomes 1-to-1, meaning there is no longer a safe haven within the risk-on sector. The economic engagement here is found in the wealth effect reversal. As the shooting star signals a potential top, the trillions of dollars in paper wealth generated since 2023 begin to evaporate, leading to a contraction in consumer spending and corporate capital expenditure. This is the mean reversion in action. It is a cooling of the economic engine that has been running on the fumes of excess stimulus and speculative leverage. For the professional analyst, the long upper wick is the sound of the needle hitting the bubble. We are witnessing the market's realization that the era of limitless upside was an anomaly, and the return to historical averages will likely be as aggressive as the rally that preceded it. The everything bubble didn't just burst today, it finally acknowledged the laws of economic physics. In the high-velocity environment of late 2025, the shooting star is no longer just a technical pattern. It is the visual realization of a massive spike in the economic policy uncertainty index. As we look back at the final quarter of this year, the hook that caught the market off guard was the sudden mid-session reversal triggered by a new wave of Tariff Tuesday, announcements. We are currently navigating an era where the U.S. import tax has surged to a weighted average of nearly 18%, levels not seen since the 1930s, effectively turning global trade into a minefield of daily reactive policy. The long upper wick of today's candle represents a rejection of risk, as traders realize that the morning's optimism was built on a fragile foundation of front-loading that has finally run its course. When the EPU index jumped from 298 to over 528 following the September shutdown and remained elevated through December, it created a psychological ceiling that no amount of AI hype could breach. The economic engagement here is found in the velocity of risk. In 2025, geopolitical shocks have evolved from slow, moving macro trends into instantaneous algorithmic triggers. Today's mid-session collapse was the direct result of geoeconomic confrontation, ranking as the #1 global risk. As the market attempted to push the S&P 500 toward 7,000, it was met with a sudden state-based conflict headline that acted as a circuit breaker for global liquidity. Institutional desks, recognizing that the U.S. national security strategy is fundamentally reshaping trade deals with China, Japan, and the EU, aggressively pivoted toward safe haven assets. This is the flight to quality in real time. The shooting star is the sound of capital fleeing the winner, takes all concentration of the tech sector and seeking shelter in the only thing that remains certain, the unpredictability of the state. Furthermore, we are witnessing the breakdown of the rules-based multilateral system. The 2025 everything bubble was predicated on the idea that global supply chains were unassailable, but the reality of 100% duties on patented drugs and 25% levies on heavy-duty trucks has shattered that illusion. This shooting star represents the market finally pricing in the risk premium of a fractured world. As 2026 looms, the question for the professional analyst is whether the South-South trade growth of 7% can compensate for the stagnant 3% projected growth in the Eurozone. We aren't just looking at a bearish candle, we are looking at the exact moment the global economy realized that the brakes on tariff policy no longer work. In the interconnected ecosystem of 2025, today's shooting star is the visual fallout of a crypto contagion that has finally bridged the gap between digital speculation and traditional equity markets. For the past quarter, Bitcoin struggled to maintain the once impenetrable 100,000 psychological barrier has created a negative wealth effect that is now leaking into the Nasdaq and S&P 500. The hook for the macro strategist is the forced deleveraging when Bitcoin slid toward the 84,000 support zone in late December. It triggered over $1 billion in liquidations across leveraged digital positions, because many of the same institutional whales who dominate the crypto space also hold heavy positions in Magnificent Seven tech stocks. They are being forced to sell their liquid winners, Nvidia, Tesla, and Palantir, to cover margin calls on their digital collateral. This is the cross-asset liquidation in real time, where a fire in the digital forest is now threatening the industrial heartland. The economic engagement here lies in the breakdown of the inflation hedge narrative. Throughout 2025, Bitcoin and Litecoin were touted as digital gold and silver, a safe harbor against a dollar that has faced a persistent 10% annualized decline. However, today's shooting star proves that in a true liquidity crunch, crypto remains a high beta risk asset. As the Federal Reserve held rates steady throughout the fourth quarter, the debasement trade stalled, leaving leveraged speculators exposed. We are witnessing a rotation to safety, where capital is fleeing the volatility of the blockchain and seeking shelter in the 16% yields of the 10-year Treasury. The shooting star on the equity charts is essentially the mirror image of the double top on the Bitcoin chart. It is a unified rejection of the limitless liquidity era. Furthermore, we are seeing the exhaustion of the ETF momentum that defined early 2025. While spot ETFs initially brought billions in institutional inflows, those same funds are now seeing record redemptions as the extreme fear index hits a 6-month low of 23. This liquidity desert means that the buy-side support that used to catch every 5% dip has vanished. For the professional analyst, the shooting star is a warning that the crypto-to-equity feedback loop has turned predatory. As digital assets face their most cautious mood in years, the wealth effect that powered luxury consumption and high-growth stock purchases is reversing. We aren't just looking at a price reversal. We are looking at the exact moment the 2025 speculative engine ran out of oil. As we analyze the wreckage of today's session, the shooting star leaves us with a sobering economic truth. Momentum is a double-edged sword. While the headlines will debate whether the bubble has officially burst. The charts tell us that the era of easy gains has hit a hard ceiling. A shooting star is often the first chapter in a story of a deeper correction. For the disciplined investor, this is the time to prioritize capital preservation over performance chasing. The market reached for the stars today, but it found only gravity. I'm Gemini, and this has been your Global Economic Pulse. Good night.